Hi, this is Randy Finney with Right Side of the Chart, and this is an early session update for Tuesday, June 16th, 2020. There were a few things I wanted to cover here today. We'll go through the broad markets quickly, just an update, look at the same levels I'm watching, what's happened since yesterday, and what to watch for today and going forward. I'll hit on crude oil very quickly since I mentioned that yesterday, and crude's been trading in line with the market, so I wanted to do an update there. There's some levels to note. And then a quick follow-up on the couple of the sentiment indicators that recently triggered some rare but pretty consistent sell signals on the market. And then want to just look at the 11 sectors in the S&P 500. I'm not going to spend a lot of time on them. I want to show you a little bit of how they're made up, what drives the market, and then those market-leading FAANG stocks. So it sounds like a lot, and maybe it is. If I can do it in 30 minutes or less, I'll be happy, because I got to get out of here today, run out and do a few errands, and I'll be back this afternoon. Start out with the broad market. Okay, QQQ. Same trend line we took out on Thursday. Remember, we had powerful sell signals in the broad market, not on the FAANG stocks, and that's what we're still waiting. I had two trend lines on QQQ. The yellow trend line here that comes off the lows back here, that is May 14th. Pretty well defined, and we had a solid sell signal there, but we went on to hit the larger trend line that comes back to the early April lows. So that's QQQ. We hit there, bounced, took it out intraday yesterday, but then recovered it. So that is a successful defense. Remember, that's a minor trend line. That's a more significant trend line, larger. So the Qs in tech stocks, really in general, continue to hold up this market. As I said last week, we had some pretty solid sell signals on the broad market, but what we didn't have any sell signals on were the FAANG stocks, and that's what I wanted to talk about in this video. And I'll get to that here. Well, we'll start out with the FAANGs, because the market is, in my opinion, the stock market, although the stock market itself are thousands of companies, across many different sectors and industries, but when it comes to how the stock market performs, there's a big disconnect, and there's been a lot talked about that recently. Rarely in history, at least in modern history especially, have we ever seen such a large disconnect between what's going on fundamentally and what's going on with the stock market as far as prices go. Today, you probably saw the news, retail sales had the 18% spike over the previous month, I think biggest spike in history, but they were coming off of next to nothing. And the most important thing, so the headline is huge spike in retail sales. Well, first of all, I don't know what the expectation was. It doesn't matter to me. But it's a given when you come from near zero, first time in history that the U.S. economy has been on lockdown and the lockdown's been released. Well, of course you're going to see a huge surge in retail sales because people are able to get out of their house and start buying things. But more importantly, when you read between the headlines, retail sales are still below where they were pre-COVID. So we're still economic indicators one after another rolling over, and that's an important one because the consumer spending accounts for roughly 2/3 of GDP. They say about 70%, 66, somewhere in there, gross domestic product. Think of GDP as the earnings, if you will, for the stock market or the U.S. economy, for lack of a better term there. And so, again, that's still down pre-COVID, yet you have a lot of these FAANG stocks that are near new highs. And again, it's really this index doing it. So wanted to mention that we had breakdowns of a minor trend line, but we held, successfully defended, even an intraday move. But remember, on a daily chart, all that matters is your daily close. So that is across the board a successful defense of that trend line, because each and every day that green candle means we close back above it. And now we're back testing. So here we are at a significant level. We're also testing those gaps from last Thursday. That's QQQ. Let's look at SPY. Because SPY, we had a even more powerful and pronounced breakdown. And remember, of the two, this is much more the stock market or the economy, the S&P 500. 500 companies spread across many sectors. Yes, it has an overweighting to technology like QQQ, but nothing near the NASDAQ 100. It's only about a quarter or so in tech. Still a big overweighting, but not the roughly half technology stocks that QQQ is. And it also has more diversified holdings among different sectors. QQQ doesn't have any financials. I think it's 0.03%, so essentially no financials. In other sectors that it's lacking. Again, it's pretty much a tech index, if you will. So that's it. Island cluster tops are still intact. They're in the gap now. They haven't backfilled the gap yet. And in this market, anything goes. Everything's whippy with a lot of volatility lately. So what I said this morning, if they clearly take out the top of the island, that's it. There's just no way to chalk that up as anything but bullish, and it would certainly dampen the bearish case. But as of now, here's the thing. We remain solidly below the trend line. Remember, there were two sell signals that triggered on Thursday, and they were pretty powerful. The island cluster top and a breakdown, the big gap, impulsive break below the trend line. So the island cluster top is one, and if they take out the top of the island, then certainly that's no longer in play, that particular sell signal, and that's a pretty powerful reversal signal. What would be in play is, in fact, we're below the trend line, we may go up and test. If we do that, we're getting so close to the highs that we'll probably punch through them. So I still don't think we're going to do it, but then again, yesterday I thought we'd reverse it where we did. I didn't think the futures would continue to climb overnight, so I'm pointing out the levels where things start to change. As of right now, nothing has changed on this daily chart. It's an impressive rally in the last 2 days, but technically it hasn't changed or negated the sell signal. So let me make that very clear. So whereas yesterday, around the where we were at the close, where I thought it was an objective place to short, it's again an objective area to short for a longer term swing trader, because now you have a powerful sell signal, a kickback rally, and again, the closer you get to those sell signals being negated but still intact, you can still and when I say an objective place to short, I'm not speaking to everybody with all positions, not those that maybe shorted here and now are getting underwater on that short. It all depends on how much, if you were planning to add to it. I'm saying from a blank slate, generally speaking, you could short now and have a tighter stop. If you shorted the day of the gap down, let's say you shorted late in the day that day, well, your stop now to set it above the top of the island back then on Thursday, you would have had to allow for, to say the island was taking up about an 8% stop. Now if you did that, you could do a much tighter stop. So that's why I talk about objective, because the sell signals are still intact. Is this rally impressive last 2 days? Yes. Are there some technical things that leave the door open for a move to new highs? Yes. As I said that day, we still had the 200-day moving averages below, successfully held and tested there, the 200 simple and exponential. Big support, like I said, the trading range back there. So the bullish case can be made, and I'll speak to that too. If you're bullish and you bought all that, into that support on that drop, then the same thing. You set your stops, kind of look at it upside down the way a short seller would, where a short seller wants, a stop somewhat either above the island. Maybe you want to go for a trendline back test. Like I said, I'm not a big fan of that, because that's going to get us up near those highs right there. And trend lines come in at higher and higher prices every day. So it's hard to say that even if we back test a trend line, where do we back test it? Here? Do we back test it once, twice? Do we keep back testing? You can always put a stop on the other side of it in case they recover it, but that's the problem. As time goes on, that trend line comes in higher and higher. So I still think stops a little bit above the island, and I also think on a closing basis, because the way this market works, wouldn't surprise me to see them run the stops and then go down. But that's it. We may not even get there. Let's see how today ends. And the reason I do these videos, is even if you're trading the SPY in a vacuum, well, I'd say the SPY needs a break, the solidly below the top of that multi-month trading range right here, that 2-month trading range. Take out the 200-day exponential and simple averages, moving averages, so something like that. However, here's what I want to get to. Although the SPY is more representative of the U.S. economy than QQQ, as I often say, and I've said for years, it's all about tech, and it's all about the FAANG stocks. So let's look at that real quickly, and that'll kind of segue into our, when we cover the 11 sectors in the S&P 500, which I'll do here in a second. So QQQ, again, broke down, back test, I already covered that, broke the minor trend line, hit the blue up trend line, successfully held it after a few intraday dips or whipsaw signals. Again, not a whipsaw if you were using a daily close, and now back testing right there, also testing the gap. So that's QQQ. Now let's look at the top holdings of QQQ. And again, this is what was covered last week. And still we have solid, not even a whipsaw on Apple. So this is, we're going through the world's largest, the biggest component of the S&P 500, largest publicly traded company here in the U.S. and it is solidly in an uptrend. And again, we didn't have anything close to sell signal. We had a down day last Thursday, but we didn't take out any trend lines, any support levels. Apple's still above the previous highs, the breakout's intact, so zero sell signals there. And as I said, and I feel very strong on this, and I say it often, until these market leading stocks break down, not just because everybody loves Apple because it's a strong performer, but because it represents so much of the broad market, so much of the indexes are weighted to these leading stocks. So there it is. That's what you need to have. Break of the yellow trend lines as I go through each of these. You have the uptrend line, and then right below that, to be safe, this is a level 327. Solid move back below there because that was our previous all-time highs, and we recently broke out. So we're a breakout to all-time highs, very much intact. Again, let's not beat a dead horse, but that's the level that needs to go, that 327, and it needs to go with conviction. And then we'll have some pretty powerful swing signals, in addition to those island tops that we had the other day. So that's what keeps those sell signals questionable for now. And same thing on Microsoft. Here's a comparable trend line, and then I have a yellow line there. A lot of reactions there about that 180 level. So that's really what needs to go in Microsoft. Other than that, nothing even remotely close to a sell signal recently. Next up is Amazon, same story, 2470, and then the uptrend line. Again, another one breaking out, a recent breakout to all-time highs, and no objective case can be made to short that stock at this point in time, other than just a gut shot, just trying to pick a top without any sell signals to trigger. 1398 on Alphabet Class A, GOOGL. Nice shelf of support right there. The divergence say that most likely this one, the upside's limited, and we're going to get a major drop. But until we get a breakdown, that one's still without any type of sell signals. There's the other share class, GOOG. And then Facebook, same thing. Recently broke out to all-time highs. So if you look at it this way, while this chart to me is very bearish, not now. I mean, the trend is bullish, yes, but the divergences, the last time we had negative divergences on Facebook was right here at the highs back then, and that was followed by a drop of whatever it was, 30, 40, or 35, 40%. So we have divergent high, and what happens with divergences? Well, we could continue to grow those divergences, but it's going to take quite a move to negate or take those divergences out, because if the market wants to rally and Facebook wants to rally for another week or two or three, those divergences would still be intact. It would take a considerable move to burn through them. So and again, divergences are not a sell signal. Neither is overbought conditions, or neither are overbought conditions, just like oversold conditions or positive divergences aren't buy signals. The buy or sell signal comes after the divergences are in place, and then you get some kind of buy or sell signal, like a break of support or a candlestick reversal pattern like we had on SPY the other day. So again, we had sell signals, but they're questionable because the market leaders haven't broken down. And that's quite unusual, but not too rare. I've seen that before. All right, now let's go through the sectors. I want to show you something I haven't covered before. I've talked about this. So, again, I just showed you the market leaders, that the stock market cannot and will not have anything more than just a pullback or a moderate correction without those guys correcting or breaking down as well. You want a 10% plus drop in the market, you need to take out the leaders, just like you did back in February. But let's look at how the S&P 500 is made up, because as I like to say, any index or a sector is simply a sum of its parts. But unfortunately, it's not that simple. It's a weighted sum of its parts. In other words, the S&P 500, yes, it's a sum of its 500 stocks. However, just a handful make up for the bulk of the returns. All right, so let's look at XLK. I always say until tech dies, the market won't die. Tech did have a pretty solid sell signal last week. I pointed that out. We had a solid breakdown there on XLK. Came down here and entered that gap, that big breakdown gap right here. That was what kicked off the big drop into the March lows. So we held that support. Not surprising that XLK has bounced back because the FAAMG did, but it is back testing, so this is something to note. And this is why I think a case can be made, not a screaming case, but a case to, to short here again. You want the highest probability short entry, it's wait till the FAAMG breakdown. But this one is back testing this minor trend line right here, this yellow trend line with that white larger trend line. This one's probably more significant. This trend line comes off the lows right here from March, and we're a little bit below it right now. So that's what XLK is looking like. Now, what I wanted to point out here is this is the largest sector in the S&P 500 by far. It makes up over a 25% weighting. So 1/4 of this, 1/4 of the S&P 500 comes from this sector. And this is the sector ETF or XLK, the technology sector. The same spiders, owned by the same company, Standard & Poor's. As you can see here, you might say, well, XLK, I can tell you right now, XLK has 71 stocks in it, right? So you diversify, yeah, a lot of tech stocks. Doesn't matter. The only thing that matters are the two FAAMGs in it, because they are 20, and this is as of today or yesterday's numbers. Microsoft is 21.22%, Apple is 21.09%. That's 42%, nearly half of the returns of this ETF, which is seemingly diversified, but yet nearly half of the returns come from just two stocks, and those two happen to be two of the five FAAMGs, Microsoft and Apple. So we watch those. It kind of goes back to what I started with, watch the FAAMGs. XLV, one of the, it's again, nothing compares to what the impact that tech has on the broad market, but XLV, the healthcare sector, has a respectable about 16% weighting. And what I wanted to point out as I go through these two, note which ones are at or near highs right here. So XLK, obviously, there's the previous all-time highs, and again, almost exclusively, not solely, but largely due to these two carrying it up higher. And it would not be here if these two were, let's say, 10, 15%, or even, anything like that off their highs. You wouldn't see XLK up here. It just, the math wouldn't work. The other ones don't matter how well they're doing. If these guys are sucking wind because of the weighting in there. So again, XLV, second largest index or sector in the S&P 500, and it's doing fairly well up near the highs. Can't knock that. So there's one sector that is doing fairly well. However, clear negative divergences. Last time we had any comparable divergences were back here. We had positive divergences here at the low. So it's kind of a wash, rinse, repeat thing. Look for these divergent highs. Although they're not sell signals, we'll look for sell signals. Yellow line should do the trick, 96. And there's a trend line that comes into play down here that will come in right under there as well. But that's it. Wash, rinse, repeat. You get these divergent highs. You get the corrections. You get the divergent lows. You get the rallies. Divergent high, corrections coming. Divergent low back here, rally. All right, simple stuff. Big sector to watch. Now, next one up, XLF. So what I'm trying to do here is give you an overview of the health of the market, similar to what I did last Wednesday when I looked at the market breadth indicators and things like that. This is about the third largest or so sector in the S&P 500. Only comes in about a 10-11% weighting, well off the highs, not even anywhere close. Financials are still, and they are a very important sector in the U.S. economy, still over 20%, solidly entrenched in a bear market, not even close to being out of a bear market yet, and that's one of the most important sectors right there. XLC, about the same weighting as the financials, about almost 11%. And this is the new communication sector. It used to be called the telecom sector. So again, we're looking at the 11 sectors of the S&P 500. Here's a strong one, not too far from the highs. Well, why is that? Simply because nearly half of this ETF, or I'm sorry, this sector, and the ETF that tracks it, is made up of just two companies, Facebook and Alphabet. There's two share classes of Alphabet. Collectively, these two companies represent 44% of this sector, this ETF. And so, again, in two of those are two of the five FAANG stocks. So, kind of just supports my thesis. And you might say, well, hey, as long as the FAANGs hold up, the trend is up, and it is. And that's what the point of the covering those FAANG stocks earlier on was. So we'll watch those closely. And when we get breakdowns on the majority of those, 3, even better 4, that should be That should do the trick for a pretty powerful longer term sell signal. Next up is XLY, consumer discretionary. This one is also pretty good weighting, or also about the same, about 11% of the S&P 500. And you might say, okay, well, here's one not far off its highs as well. One single stock makes up a quarter of the return. So again, not very diversified when Amazon accounts for over 24% weighting. So you won't see this one. You're going to see this one moving up and down with QQQ, because Amazon's going to move up and down with QQQ. And the tech sector, really, even though it's considered, they put Amazon in that category, consumer discretionary. It used to be considered a tech stock, because they were the first big online retailer. And then you go down the line and you see really the health of the stock market when you look under the hood. Industrials, where are the jobs in the economy? Where are is the overall health of the economy? Well, industrials, that's a good sector to look at, just like financials, and it's way off its highs, about 16% off the all-time highs, so solidly entrenched in a bear market. So there's a common theme. Other than healthcare, you go down the line, and we're done with the FAAMGs now. All the other sectors within the S&P 500 are well off the highs, still in bear markets. This is energy. Energy topped so long ago, it's hard to argue this is anything but a bear market rally, as impressive as it's been. And I won't even measure it. You can see from 80 down to 40. This is still 50% off its previous high. What am I talking about? The highs were way back here in 2014 or something like that. Much more than 50% off. Energy has been in a vicious multi-year bear market for quite a while, and still is. Utilities, same thing, well off the highs. No FAAMGs, no tech stocks, nothing like that. And it's down 16% off its highs. REITs are down off its highs. So that's it. So the stock market and the economy is not doing well. The economy has actually fallen off a cliff. The numbers have rebounded from where they were a month or so ago because of a lot of the reopenings of states and things like that, but rebounding off super low levels. So again, 18% rebound in retail sales still puts us below where we were before the whole COVID thing started, which makes no rational justification for the stock market being where it is, other than what the Fed has done, and again maybe some disconnect between consumer or market participants' expectations of where the economy is going and where the stock market should be valued. So that's all fundamental stuff, and now the trend is up. So I already gave you the levels to watch. Let me just show you on futures as well. Yesterday, I had to replicate these charts. I don't know if you noticed that on the home page. Very annoying feature with these charts. When the futures roll, they stop providing. The charts just blank out, and I have to replicate the charts with the new. These are the continuous contracts. When you see that little infinity sign, it's a continuous contract. But the previous futures, they stopped supporting those, and they now moved to the September contract. So what I'm getting at is you'll notice the numbers are a little bit different because they've rolled it to the next contract. But there it is, clear stuff. Sell signal there. While I didn't get the reversal where I thought, I'm just as confident, if not more, actually, right now that we'll have a reversal here. One thing we didn't have yesterday was divergence. And you know me, it's simple but effective. You look for these divergent highs and look for these divergent lows, and that's it. This is a divergent high. It might not be very large divergence, but it usually doesn't take big divergence, especially when you have a very steep trend line, and it's a pretty well defined trend line. Same one I had yesterday on the charts. We were above it then. We tested it last night here after hours, and then moved up, and that's it. So a little more downside. If we can break it, a solid 60-minute close, that should do the trick. And let me give you, if you're an active trader, I'll give you some targets. We have a cluster reaction lows right here, and then this reaction high. I'm gonna put it right about there, I think, because I'm looking at these two reactions here. That would be your first pullback target. No, that's not correct. If you want to look at micro levels, where you probably get a little bounce, I see a little bit of support right about here. But I do think we'll come back at bare minimum on a break of that if we get a solid break back to here, 97.94. And depending on what happens from there, if that level goes, then that could open the next leg down. Like I said, if those sell signals remain intact on the S&P 500 that we had recently, the island top remains intact, and we can get a reversal, then we still need to see the FAAMGs go, and they're, like I said, as of now, comfortably above their uptrend lines, but this is kind of near-term stuff. Should we punch on through there and go much higher, then what's going to happen is divergences will be gone. We won't have any more divergences here on the 60-minute chart, because the indicators will go on to make higher highs, as will prices, and then the NDX will want to run right at that previous high and maybe punch through it. So this is what I favor. We didn't get this yesterday, but again, we're at resistance, and this rally, I think it's just unfounded. And then to speak back to the fundamentals real quick, I know I'm throwing out a lot here. I want to get it all in. What's going on with COVID, and I don't talk much about COVID because to me, that's already priced in. It's already a known variable. I think sooner or later they're going to have an effective vaccine and treatment for it. They don't now. What I do know, it's been in the headlines recently, we've seen a notable uptick. My wife works for a large pharmaceutical company, and part of their thing is they're in close contact with the hospitals, and she's been telling me for over a week now. The last couple weeks they've been seeing a noticeable increase because they can't send their sales force. They don't want to risk their sales force going out in the field if COVID is flaring back up, and it has been. And it's simple, and I talked about it back when we had the shutdown. It's simply a positive feedback loop. Everyone was social distancing and quarantining and staying at home. Yeah, the cases dropped. Market rallied on that. Of course, that's the obvious. If you sit at home, you're not going to catch the flu. You're not going to catch COVID. You're not going to catch a cold if you're not in contact with anyone. Get out, it's going to happen again, and that's what's happening. So it's a positive feedback loop. The more restrictions open up, people go out to the store, start buying, retail sales go up. More people are going to get COVID, and now we're hearing more backpedaling and talks about, locking things down again. Because at the end of the day, all these promises for treatments and vaccines, yes, like I said, we'll get one eventually. How effective it'll be, who knows? But we don't have it now, so that's it. So the positive feedback loop is more people start going back to work, economy starts to pick back up. People go out shopping and all that. More COVID cases, more talk of shutdowns. More people get scared, stay back at home, don't want to go out to the grocery store, don't want to travel, take vacation, all the things that cruise lining, the cruise ship stocks, Carnival, all those rallying and everything else rallying, and expectations that people start going to Disney World and taking cruises again. That's what a positive feedback loop is. One thing goes up, the catalyst, and then it causes something else there. You could also look at it as a vicious cycle or vicious circle if you want, same kind of thing. So that's that. But again, to me, I sit here and talk all day long about fundamentals and why there's big disconnect and what impact it will have. It will. Think about gold-silver ratio in the past. Many times over the years I've covered when there's a big disconnect, when that ratio gets really wide. Gold and silver have a ratio. They usually one's priced to another. And when sometimes you'll see gold rally, we did that earlier this year. Gold had rallied. Silver was way behind. And I said silver's poised to play a game of catch-up. And I've done that several times to the upside and downside. And that's where the big trade is. Silver, in some of those cases, rallied 30% or more, while gold sat still, while silver played a game of catch-up. Well, where I'm going with that is, mark my words, the stock market and the economy will. There is a disconnect right now, and there will be a reversion to the mean at some point. And what that could be, look, I have to be very open-minded when I do this. I think the mean reversion will be the stock market, especially those tech stocks, catching up to where the fundamentals are and where it should be, valuations. But if I'm wrong, maybe it's this. Maybe the fundamentals play a huge game of catch-up. We're seeing, obviously, recovery in the trend. Everything I just talked about, retail sales, all that other stuff. So if the economy suddenly just, all this fuel that the Fed's pumped in shoots the economy up, that could be the mean reversion where the fundamentals catch up to the stock market, and then the stock market can continue to rally without correcting. However, I think it's the other way around for many, many reasons, including but not limited to the technicals, largely due to the technicals, that the stock market will be, this is where the mean reversion will be, stock market catching up with the fundamentals. So couple things additional as I'm doing the video, and I'm going to wrap this up soon. I told you it wouldn't be too long. There's a breakdown in NQ right now, so as I'm doing this, there's a sell signal, and I'm going to pause this. And I was going to fire off another NQ or two, but I'm going to wait till this level goes right here. That's that support I give you. A little more downside should open the door to more selling. So there's the divergent high. It's certainly confirmed rejection off that resistance. So far so good. Crude oil, I wanted to show you CL. I talked about it last night being an objective short. That was contingent with the market going down, and right there we were at that 37.39 resistance. So, short it with a stop a little bit above, so that one would have been stopped out. However, just like the stock market, we have a trend line right there, and we're at resistance. I've added this resistance level since right about 39. A lot of reactions along there, you can see, and you have a nice trend line. So it's either an objective short here, maybe a bit of a pot shot if we get a little more downside on NQ, get that sell signal confirmed on that break of that support I just told you, or you wait for crude to break that level, and then this would be, that was resistance yesterday where we're at. That would be your first logical support level, and then if and when that goes, that would be your next objective short entry. After that, a break below, solid break below 37.39, open the door to 34.76, and then if we can take that out, I should add, I think I had it yesterday, let me add it here for you. There's a little bit of support. This is a support zone from about 34.76 to 34.43. So break under that support zone should do the trick then to open the door for a much bigger drop. As of now, the trend is up. We're at resistance. No sell signals, but that's, two ways to short that I like to short. Is either a rally into resistance or a break of support, just like I like to go long on a pullback to support or a breakout above resistance, like that. Not that I did that, but in hindsight, that's what I would have done. And last but not least, let's go back to last Thursday, or just recall Wednesday, right before the market broke down. I went through some various sentiment indicators, and as I like to say, I know there's always focus on the sentiment surveys, which traders say they're bullish or bearish, like the AAII. But again, I always say they're not putting their money where their mouth is. Not necessarily. It doesn't mean that they're, they might say they're bullish or bearish on the market, but they might not have a position. They might tend to go long or short, but they don't do it. Whereas this shows you where positioning as. This is the put to call, equity put to call ratio. So these are put to calls on stocks like Apple, Amazon, Facebook, or any other stocks out there. Whereas we also have a total put to call ratio and then an index only put to call ratio. And what I have a blue line there just shy of 40, about 38, and that is the magic number. We've only hit that level 1, 2, 3, 4 times going back for years. This is the entire previous bull market right there. So we're back in this is the '08 meltdown there, and those are the only tags. So what I said is it's pretty darn reliable, and when you have these extremes, that means everybody's bullish when we get down to that point. A lot more people are buying calls than they're buying stocks, and that's why you have this drop to such extremes. And again, what I like about it's a very rare signal. That was up to the point the biggest drop. That was a significant drop. Here we had another reading at that level, and now you might say, well, wow, the market actually went higher, and it did, barely. It pretty much flattened out for a couple months there, and then the big drop came. So the takeaway from this, and I've talked about this quite a bit in the past, is these are not timing indicators. You don't hit this. Sometimes you hit it and that's it. Sometimes the top is there or comes pretty quick, usually a couple days later. I don't know if you can make it out. I have dashed lines here on the chart. They're very subtle. They're little but it shows you where they are. So that one came a few days after the signal was triggered. This one again came a couple months, but yet the market, because of that extreme bullishness, it pretty much put a top, and we traded sideways for a couple months, a month or two, until the big drop came. Here we had a reading right there, and again, same thing, came a little early. The market had minimal upside, if any, traded mostly sideways, slightly higher, then came a drop, and it wasn't a huge drop, but again, what it did is, this was, do you guys remember, I'll tell you if you were trading or not, this was a sideways market. We traded for nearly 2 years in a very tight sideways range. I didn't do a good job of boxing in, but the market went pretty much nowhere, and again, that came after that signal. So in that case, we corrected more so in time than in price. You would have been well to get out of the market as if you were long back then, even if you don't care to short, and you would have sidestepped 2 years of watching your gains and losses go back and forth, back and forth. Finally, we broke out of that right around, that's when the Trump pump started. Okay, so point is 1, 2, and the only other time after that, there was 1, 2, 3, I'm sorry, and this is it, the one that I mentioned the other day, and it's just fresh. So sometimes you get an immediate drop. Is there a 100% effective sell signal in the market? No, but this is one of my more reliable ones, and it's more reliable because it doesn't give you many hits. And again, there's a fundamental reason other than this technicals. More technicals, we're looking at a chart here, but it's telling us the fundamentals. It's telling us that the vast majority of the vast majority of market participants are bullish, and that usually creates imbalances in the market that have to be corrected. All right, last one, and we will wrap the video up. I covered the the CPC the other day as well, and okay, this is the version of it that I covered, I believe, right here. That's it, simple stuff. You hit this level, that red line down around, and this is the total put to call ratio index. I said it either comes on single tags, one and done, 56% drop. That came right after the start of the last bear market with a 56% drop there. Or you look for these clusters, and a cluster is more than one, usually 2 or 3, sometimes 4 of those readings in relatively close proximity. So what it is, it's a environment of persistent bullishness, not just an extreme spike. And so there it is, 18% drop after that one right there. Let's see, get back on here, 18% drop. Not working here. Something's going on. 1 second. Okay, I had a little issue with my screen draw tools. Still am. There's something going on here. Oh, I see. I've got that chart cut off. Okay, no wonder. I'm using a much larger monitor than you're seeing here, and this is part of it. There it is. So 56% drop, 18%, 21, 10, 16, and like I like to say, nothing's 100%. That's why I point out we did have a series of persistently low readings there that triggered without a correction. But going back, spanning over a decade, including the last bull market, we went 1, 2, 3, 4, 5, 6. We had the last ones there, followed by that 36% drop. And here we are again. So this one, history, only time will tell. So we are 5 for 6 out of the past decade. I'll take those odds all day long, and that's what we had there. So here's the extreme. Could this one go longer? Could it end up being a cluster? It could, but based on everything else I'm seeing in the charts, tell me more likely it's going to be a one and done based on where we are with the technical posture of the indexes and everything else. So that is it. I want to wrap it up here, get this video out to you guys, and just confirm as I'm doing it, we have there's our sell signal right there on the NQs. Drop down below that level, break down, and as I said this morning, it'll probably be pretty quick because there was a lot of hot air in this rally there. So should be more downside to come. I'll do a wrap up at the end of the day. I've got to step out of here for a couple hours and knock off some errands today. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.